Hi guys, it's CryptoBirb, Adrian speaking. Welcome to today's Friday webinar. Rough week for equities, rough week for all the stocks out there. Well, there's not been too many stocks. There have not been too many stocks basically that have gone up even a tiny bit during this week, except for the energy markets, which comes from strong drive and momentum, the oil and the gas markets. Well, we're going to discuss how it all kind of like correlates and translates to Bitcoin's prices and why this month is, well, pretty much exceptional and pretty much likely going to be the very major month. Will it be different than what we've seen so far? Let's make sure to give it a deeper check right in a second. Welcome. Please let me know, everybody, how you guys are doing today. Beautiful weather up in Poland, beautiful weather. Hopefully, in the places where you are at, there are some people joining in the stream. Of course, the sentiment has been extremely low. It's also seen and represented directly in the number of viewers to the streams. I remember a couple of months ago, there were like thousands of people literally watching this live. Right now, we are just talking to a bunch of the biggest veterans, I should say, to the biggest pros in the markets who are resisting to really go broke. And well, hats off to everybody who's still watching. Make sure to let me know in the comments how you guys are doing, because you're one of the very few market participants who are still left. And and trying to combat in the markets for the wins. We're going to give a check and kick it off with a bit of news. With a bit of news check, I hope everybody can see the screen. And we are, of course, talking about this week's FOMC meeting, decision from Jay Powell, the chairman Jay Powell, on getting a little bit more dovish than expected resolutions, I should say, for their votes, as the Fed announced 50 basis point rate hikes, which is quite exceptional and pretty much rare and seen in years. And yet there was enough confirmation as the market was pricing in, to be honest, with 99.8% certainty or chances or votes in the polls, the rate hikes, which would be more aggressive than they actually were. People in the market participants were fearfully pricing in 75 to 100 basis points increase. And just like behavioral finance practitioners would argue here, the perception biases, the entire prospect theory, the emotional states and conditions that we tend to undergo as people, as human beings, tend to impact our logical and rational decisions, making it much more far-fetched, just the way that people expected way bigger rate hikes than they actually were. 50 basis points is still high, although there was somewhat a rapid of bullish reaction at the very same minute or day, hours that the decision was announced, which had to do with a little bit of more uh, quote unquote bullish surprise, right? People were pricing in higher rate hikes. Instead, Jay Powell said 50 basis points and no 75 basis points or higher were considered at this time. This was taken in the market as somewhat more bullish than not, right? And immediately impacted the market the way it stood right there. Funnily thing, or well, it's not necessarily funny. Perhaps that's a wrong word for many people, but a very interesting note from Steve Depp on CMT. And I quote, "It's official. 2022 goes in the books as the worst start to a calendar year for April's close in the S&P 500's history, down roughly minus 13.3%. Previous record was 1970s 4-month decline of minus 11.45%. Let me repeat and highlight the importance of this. The past 4 months, including the April's close, was the worst opening to the year, was the worst 4 months recorded ever in the year in S&P 500's history, in Standard & Poor's 500 index history, right? This is This is exceptional, right? Last week I was talking about situations and then the market conditions that you're looking at once in generation, once in 40 years, right? Especially following the upwards breakout on the 10-year Treasury T-note yields, interest rates breaking above 40 outside 42 downwards 42-year long downwards trend, which I'm going to also discuss briefly in a second too. But we're talking about exceptional situation, inflation which is galloping, of course, double-digit inflation. It's going to be very, very hard for the Fed and for the central banks to combat this high inflation with with relatively low rate hikes, if you will. In Poland, for comparison, of course, it's very, very difficult to compare many different countries, but just for information, I think there's a discussion going on for over getting the rate hikes to an actual point on a scale to 5%. For the overall interest rates, of course, so the borrowing becomes way more expensive, and the economic growth slows down heavily. And of course, globally, we're talking about the U.S. economy. We're looking at inverted yield curve situation, and more often than not, over the course of the past years and decades, each and every single time of the past 7 recessions encountered, the inverted yield curve had been a successful predictor to it, right? So if that actually comes true, we're talking about recession coming in about 6 to 9 months, ideally, but more often than not, you see some sudden changes to it because the model is more of a theoretical approach, and the practice tends to become a little bit different and deviated. So having a look into the markets, right, into the very markets, we're talking about Dow Jones Industrial Average. Industrial stocks actually bouncing slightly off yesterday's, off the most recent lows, the May's lows of 32,500 points, nearing the support of the prior lows of February, also around this level. So it does seem that, in fact, this is somewhat of a strong support region, mid 32,000 points. For the index is definitely something that you want to see get held or get held, defended, maintained, if you will, by the bulls. Otherwise, the things can go way more south to the downside. We are, of course, looking also at some stock, sector CTFs, and just the only one that is basically upwards strongly is, out of all this list, out of this consumer discretionary staples, more defensive markets, you're only looking at energy sector, which is somewhat more green-ish, if you will, plus 2.42% as of today. The energy sector, of course, it's actually dancing and breaking into new highs as we speak right now, 82.5, showing strength driven mainly by oil prices and the gas prices. Here we are looking basically at consumer discretionary tanking, taking a strong hit after somewhat of a bullish increase. In March, somewhat of a sharp increase March through April, but then taking a heavy pound downwards. Financials, of course, taking a hit, which is somewhat surprising. Here, healthcare taking huge nosedive ever since peaking in April. Healthcare, consumer staples, utilities are typically more defensive sectors to equities. So you would expect them to perform well when there is some crushing environment, when there is a lot of uncertainty, when there is more defense and the risk of approach and environment. And instead, you're looking at all the equities groups and sectors basically tanking. Stocks were very heavy, have been very heavy. Real estate, of course, down as well, driven by the higher rates. Interest rates definitely increasing, impact the cost of borrowing, like I said, and of course the market, the real estate market doesn't take it very well more often than not. Besides, just like I said, you're looking at the historical breakout, outside the 42-year long downwards trend. We're talking about the 10-year T-notes treasury yield, okay, returning 3.05% as of now, and we're looking at a 42-year long downwards trend on the logarithmic chart that is actually being broken as we speak for the first time over 40 years. So let me re-emphasize how exceptional the conditions that the market has become, has visited into, it all is. It is very exceptional. It is very generational, and not really a typical environment that you're looking at, right? So let this as well sink in a bit as we go and actually move slightly a little bit towards the Bloomberg Commodity Index, which is the index that I actually use to check on the health of the commodity markets. And you can tell the commodity markets has remained somewhat strong uh, so far, maintaining the price action trading and in the upper bound, in the upper range of this entire consolidative period between 115 and 136 basis points here for the futures, because this is Bloomberg Commodity Futures. So the futures prices is what you're looking at the price chart in this very chart. After marking out the local top, arguably tweezer top or some form of a double top on the higher time frame, formed by the abandoned baby or evening start gap up, the baby, the candle doji, and the gap down. Similar, mirror reversal pattern, if you will, on the other edge here, bounced off the 50-day average, which is the orange curve here, providing support, and broke to new highs. But you can tell there's not too much of momentum, I'd argue, right? You can see a lot of small bodied candles, so-called spinning tops, or doji candles, which are showing a lot of indecision, a lot of um I should say momentum missing, right? The momentum is missing, you could argue, but still it's trading in the upper half of this consolidative period, which is somewhat more promising than not, because as long as it does maintain the support of the 50-day average, the commodities are somewhat safe. I've been a little bit surprised. I've been a little bit surprised by the weakness of gold, which is something that you see in the chart over here. This is an overlay of Bitcoin chart in the reddish curve, and the very black curve is the gold prices, right? And the gold prices have really taken quite a strong downturn recently after peaking in and of course Russian invasion in Ukraine, which elevated the amount of fear. The VIX, and other fear and greed index barometers, were pretty much like piling up high numbers, high figures, and and you can tell that for quite some time there seemed to be somewhat of negative tendency in terms of the correlation. You can tell that Bitcoin had been taking downturns, gold was really taking an upwards direction out there into the north. And this somewhat reversed very recently, right? As the market had become way more cautious, and driven by the risk of environment, late April through May, which is something that we're looking at right now. It is not really too often that Bitcoin tends to follow, gold very, very carefully. And accounting how strongly Bitcoin is connected to equities, you could argue as well that right now it's somewhat of a strange situation where gold, equities, and Bitcoin are all following the very same direction. It's not always the case. It's rarely ever the case, to be honest. Still interesting to observe. I hope you guys, by the way, are doing okay. There are some good comments, beautiful people. Claire, Pauline, hi, good morning. Burb, good morning. Back to you. Karen Carden saying always brilliant. Thank you so much, Adrian. Much loves. God bless. Back, of course. There's imagine being 40 years in a short position. Well, of course, there is always going to be, if you wait long enough, there's always going to be some time that you're right about what you expected 50, 60 years ago. I know people who shorted entire rally of Bitcoin in 2020 of $44,000 lows to 60,000s or 50 it was. One way or another, All that being said, I want to take you to the considerations for how exceptional overall the situation is, and the tips that I hope that you guys are going to take away from this short webinar, this short showcase study. Well, are going to actually save you a lot of money, are going to save you big in the real meaning of it. And there are certain reasons for it, which I'm going to actually talk about in a brief moment, on top of what I've already mentioned. But uh, you know, typically the markets tend to the uncorrelated markets or poorly correlated markets tend to increase their correlation in the difficult times, in the times of uncertainty, as the markets, when they crash, they tend to crash together, forming some sort of selling climax, if you will. When there's selling climax, and more of this depressive environment in the markets, that people are somewhat revulsed. There's a lot of revulsion. People really hate trading. They lost already their money, and they really want to translate their hate and then pose it somewhere outside of them. This typically comes with sort of reversals, of course, not necessarily the very major big reversals, but at least some short-term recoveries. So far, the fact that you're looking at gold and Bitcoin tanking together along with equities speaks a lot of the sentiment, because they usually, gold and equities, tend to follow opposite directions more often than not. And the fact that they're all tanking together, the last time I can remember it happened was actually in the COVID 2020 time, effectively, when everything was tanking, when everything was dropping heavily, smashing through the supports, mercilessly, if there is such a word even. So yeah, lots of readings were really recovered, or I should say, taken back to the levels from the COVID times, which is also another exceptional thing to note. Is correlation coefficient on the bottom of the composite index, which is a little bit of more risk on appetite barometer. Here you're looking at, of course, rejecting at the 50-week moving average, well, and taking it into a proper downwards trend, right? After topping out over 16,000 points, and not managing to reach this 15,000 point resistance, the polarity flipped and the support became the resistance once broken. So you were looking at the market was really showing a lot of weakness in the 15,000 points area, and never really actually broke above the 50-week average, which is also exceptional, because the last time it happened, it was basically the COVID crash, right? So here, of course, the downwards trend is somewhat confirmed. It should be confirmed with an ugly close below, well, the mid 12,000s, 12,500 points. I do not personally expect it as of now, but of course, anything can happen in the next 3-4 hours to go. Just remember that, well, we're talking about a very, very big amount of uncertainty that was not there in 2020 after post-COVID crash. Of course, in 2020, you're looking at it, at equities, at Bitcoin having strong recovery and strong rally upwards for the vast majority of the time out there. And right now, you're looking at exceptional environment of very big instability and indecision, question marks everywhere. Recession ahead, potentially inverted yield curves, bringing those death wishes from the market itself. On top of that, you're looking at war, a real war unseen in years prior to it, in decades. And such a violation hadn't really happened until, or I should say, since the Second World War, if you will, of this caliber. Um, so lots of very strange things that are really fundamental exogenous that the markets do not take well so far. But this composite index taking new lows after breaking through the support in the mid 12,000s, is definitely not so much bullish. You can see correlation at 0.99. It's as high as it can get versus the S&P 500, which tells you that they trade together. Right now, you're looking, like I said, at S&P 500 as well in terms of its RSI, which is the momentum oscillator. Tells you it's kind of like in this no man's land. It's neither oversold or overbought. It's not in neither of these regions, proving any sort of like reversal divergence, if you will. So far, it would tell me rather much more than not that it's, if anything, should there be a weekly close below daily or weekly close as a result below the prior support of 4020 or 4050 for S&P 500 for the large caps, then I would argue we would go and see lower levels, especially with big amount of uncertainty through the weekend when the markets are closed. I hope you can still follow what I'm saying, guys. Please let me know if what I'm sharing is somewhat clear. Well, I do hope that you guys are really well following through what I'm saying and how exceptionally risky the situation is. This tip itself directly translates to the suggestion from me to you so that you do not take anything for granted in this market. And well, it is an exceptional time. I keep repeating that this over and over again to make sure this anchor stays with you, stays in your minds, because it will directly translate to your risk appetite as well. There is not so much risk environment, uh, risk-friendly environment. This is not a friendly environment for you to open tens of trades. Just go and rest easy, lying on your bed, on the sunbed, just taking chill moments and let the trades run. This is not an environment when you can, just let yourself not apply portfolio management as in portfolio diversification. This is not the best time to get overexposed to risk, to invest in many altcoins and many assets that are just like Bitcoin, risk on equities as well. You can see all of the stocks are basically dropping. Netflix being 70% down. This is really, really, really difficult stuff. And of course, of course, there are there are comments about the wars. There, I hate this about. I mean, I rarely ever say that, but I really do not appreciate that we as people, as the humankind, would always strive for getting to kill each other for money in wars. So each and every second, probably right now that we're talking, there is war somewhere going on. It's terrible. I highly believe in goodness and injustice, and would never endorse such a thing. Back in in the commentary, I want to guys make sure that you pay enough attention to the correlation coefficient at the very bottom of Bitcoin weekly chart, and this is a bar chart and on the bottom section there is Bitcoin USD to S&P 500 correlation, and it shows you from -1 to +1 how negatively correlated to the downside it can be, which means that the stocks as equities and cryptos will follow exactly opposite directions, just like you would see in April through April to July to 2019, or highly negatively correlated markets in as we were nearing 2020 prior to the COVID regions. Right now we are talking about 7-week basis, and on a 7-week basis the correlation coefficient is 0.91 on the max level cap of 1.0. So it is a very, very strong correlation. And like I said, when the markets crash, they tend to crash together, the correlation increases more often than not, which does not help Bitcoin at all, right? You're looking at somewhat of a pattern. This many people would call it a bear flag, but in all honesty, I had covered on the previous webinars why I would never call it a bear flag. Of course, some people can argue it's just nomenclature and it doesn't really matter how you call that. Partially, I can agree with that, but just for the sake of using and talking about the very same instances, examples, case studies, and patterns, I choose to call it properly. And to me, it is an ascending channel counter, post counter to the prior downwards trend, typically serving as more of a correction. Especially after most recent yesterday's breakdown of 10, Bitcoin tanked 10% to the downside. It wasn't really, it was in a lot of exaggerated sell-offs. To the best of my memory, it was 300 million of liquidations on the long side, if I'm not mistaken. Correct me if I'm wrong, but still, 50-week average right now is at 44,735. And as long as it's not reclaimed, as long as it keeps getting rejected, Bitcoin is not really in favor, is not really put in favor of higher price increases, anticipations towards the resistances higher, in the upper $50,000, $60,000 regions. Right now, we're looking at a somewhat of a breakdown of the diagonal, the breakdown of the diagonal at $36,000. Right now, there is a chance, of course, we would revisit $33,000, and this would not really make it far away from the lows of $30,000. I'm not saying this would necessarily happen, but if there is a lot of volatility, downwards volatility to the equity side, on the equity side, Bitcoin, through high correlation to equities, would probably follow it, because when the markets crash, they tend to crash together, regardless of the prior correlation. So just like I said, equities crashing, the market crashing, on in the stock market is basically not really going to do well, probably, to Bitcoin either. So all that being said, the worst of it all, we are still in sideways. This is the biggest pain in the arse, I should say, for all the traders, because typically when you could it was very easy to spot, in 2018, I would argue that the market kept taking lower downturns, and it kept making lower highs and lower lows. And instead, we are here looking at a sequence of higher highs and higher lows. This is terrible. But you're looking at $65,000 high of April 21, 28,800 through quarter 3 21. Early November, it's $69,000, which is a higher high compared to the April high, and then $33,000, which is so far the actual low for the movement ever since 2022 kicked off. So we're looking at an ascending sequence of price and lows, of price highs and lows. This makes it an upwards trend, right? And no matter how irrational, how I should say, not irrational. What I'm saying is emotions tend to impose certain filters, irrationality filters, on in your mind, in your eyes. And even a flat market, a market that keeps moving sideways, it makes you, the emotions make you think that this is bearish, right? In all honesty, sideways is as neutral as it gets. Downwards trend, a sequence of lower highs and low lows, is bearish. Upwards trend, which is a sequence of higher highs and higher lows, is bullish. But sideways, which is neither this or this, sideways is neutral. So people are calling it a bear market, despite it keeps printing sideways candles, sideways bars. It is, I'm saying it is worse because, contrary to prior bear market, where you could easily just tell that this was a bear market because it had this descending sequence. Right now, you're looking at the market that keeps ascending, and the worst of it all is that it doesn't help you position yourself well, because it keeps moving in sideways, which is a very choppy environment right now. So far, it's leaning slightly more near term towards more bearish resolution, more bearish resolving to the pattern, which could arguably take you down to the $30,000 levels back again. And if that happens, you would wait for this for the support to hold out there, right? But worst of it all, we're still in upwards trend in the long-term direction. I mean, I don't know. It's just sentiment is this bad that people can really want you to die when they tell you that, when you hear anything bullish. This is the state of the market. You say anything bullish, even if it is bullish by the chart, right? I'm not saying Bitcoin is bullish in the short term. I think it's actually bearish in the short term and in the midterm, but I'm saying it still holds this higher ascending sequence of higher highs and higher lows. This classifies that technically and really as an upwards trend. You don't look at downwards trend, which makes higher highs and higher lows. You don't look at bear markets, which keeps climbing higher. The bear markets keep climbing lower. So I would call it a bear market only after we actually break through 28,800s and close a week below. This could be definitely indicative for further sell-offs coming up potentially. But all that just to tell you guys how much fear there's been in the market. Of course, historical levels. Again, fear and greed index is barely a sentiment barometer. It tells you about the overall consensus opinion from the speculators, from the traders, who tend to be more often than not less experienced than the people who drive the markets, right? The money that drive the markets. You can tell that we're in the very extreme regions of history for Bitcoin. Right now, you're looking at the levels of fear and uncertainty seen only in the worst crashes in the market, as in July 20, quarter three, 21, COVID crash, the bear market depths, the lows prior to the bear market depths. Uh, you know, of course, the past is never a guarantee of future performance, right? So the fact that certain pattern appeared in the past, it doesn't mean that it's going to ever exactly unfold in the same way, but it still can be indicative of whether or not, uh, Bitcoin via the Fear and Greed Index, the sentiment readings, is considered rather cheap or expensive. And you can tell that sooner than later, after Bitcoin had spent some time in the fearful environment, right? Uh, it later returned positive movements, right? In the depths of the bear market, the complete depression revulsion stage of the market lasted for 4 to 5 months, similar to this one, of course, right? With this difference that we keep, like I said, making higher highs and high lows, which cannot be classified as a bear market technically. And there is a lot of difference to it, right? Some people could say, okay, that this is a bear market, but like we're talking about the 4-year cycle, right? For Bitcoin, for presidential cycles, the last 4 year. Equities tend to follow 4-year cycles as well. At times, just prolong the 8-year cycles, double the presidential cycle. Bitcoin is moving. The cycle is basically the time between the very peak of the past cycle, which was their $20,000 in December 2017, right? And the peak, which so far is this, is of course of November 21. But the fact that we're still, moving very slowly, but still like climbing higher, tells me that we're not done just yet on the upward side. Still, same measurements, between the Bitcoin's price history, you're looking at basically way to measure the cycles of marking the two subsequent lows in the markets, right? So you're looking at the bear market floor of 2013 cycle, 2014 bear market, and 2017 or 18 the bear market lows, right? This is clear confirmation that the distance, the time length period between the two lows in the markets, to depression and accumulation ranges, well, this is what makes and constitutes a cycle, right? Or the time of 2013 peak to 2017, another 4-year distance out there in the time wise. So all that being said, guys, I really I would really want you guys to recall what I just said. The prices in the shorter term direction, as long as nobody can really guess the future, right? The charts are not going to tell you when there is, certain price shock coming, or where Elon Musk tweets, or when Elon Musk tweets about Bitcoin or Litecoin or Dogecoin or any other coin at all. Charts are not going to tell you when Putin is going to invade another country or drop nuclear weapons, right? Bombs. Charts are not going to tell you the future, but they can be powerful indicative source of letting you assess whether something is relatively cheap or expensive. And this is the way you should use it, right? So all that being said, I've remained cashed ever since Bpro pretty much brought this bearish indication, this bearish note, because this is the way I traded. Like I'm a trend follower, right? And of course, there is going to be a lot of chop. There is going to be a lot of fake signals or I should say, inefficient signals in the sideways, in the choppy environment, in a very risky, directionless environment. But you pay your due costs for the sake of lower win rate. Let's say my win rate is probably 30-40%. It's very low, but then I'm waiting, protecting against my losses. I'm waiting for protecting my losses, which means I get positions cut when there is a loss, when there is certain threshold on the downside, kind of like broken. I get cashed, just like I was here, from $45,000, and you kind of like get chopped in sideways, just like you would typically do, just like turtle traders would do. Any trend follower technique would put you there, resulting in low win rate. But this means that despite there is low win rate, and let's say 3 out of 10 trades are won and 7 out of 10 trades are lost, then those 3 wins are large enough not only to compensate for all the losses that you encountered, but also to actually pay premium and generate actually positive returns. Because trend following breakout systems, which is something that I am actually applying here with the Burbigator Pro system, is actually academically and well and statistically and empirically proven to be the best performing one, right, against mean reverting, which works best in momentum trading in sideways environment. So here you're looking at getting chopped a little bit, in the sideways environment while waiting for this long run, right? For this long run that stays for you from $63,000 down to, let's say, 40, right? And you get chopped a lot in sideways when you finally manage to get this final breakout when it catches on the trend side, and the trend helps you position yourself and generate this excess returns, this so-called fat tail to your profits. I think it's very important to understand that, right? But still, I remained cashed for the entire month, basically ever since very early days of April. On my short-term positions, I have never escaped my longer-term positions just yet that I had held, for quite a long time. Because, like I said, I still believe the chart tells me that as long as it keeps climbing higher and higher, making higher highs and higher lows, there is no reason for me to escape from my long-term positions, right? On the shorter term environment, I actually trade 12-hour chart, right? So this is the very chart that I'm looking at. I had remained cash, like I said, on my short to medium term positions ever since the early April days. And well, frankly speaking, we're looking at lots of weakness right now, in my opinion, in Bitcoin. Of course, like I said, the closing of the week is going to be the most decisive one. New monthly lows are definitely not appreciative, not indicative of bullish strength so far. But as long as there is certain support that is broken and it still manages to close over that support, this still validates and contributes to the support validation rather than just canceling it, right? So it does take a close below certain threshold support or resistance to make it valid. Same works upwards, right? It needs to hold and maintain and close over certain resistance to validate the breakout. Otherwise, you're looking at choppy fake outs sequence, which is exactly something that you were looking at prior to the drop, right? I'm talking about $46,000, which was previously tested many times successfully, right? Lots of upwards reversals there, lots of upswings. Finally, after it got broken, you got to see and observe this polarity flip, right? Where the support, once broken, became the resistance, and there was a couple of instances of rejection, then finally a breakout, which later appeared to be a fake instance and a failure, right? As the market did not manage to maintain the main support region at $46,000. It did fail, and instead, the failed patterns, the failed breakouts tend to perform better in the opposite directions than the regular ones in the expected and anticipated directions. So far, you're looking at a lot of, I should say, unsupportive themes for Bitcoin bulls right now in the near term. And in the near term, do not confuse that with the long term, right? Bitcoin can be ultra bearish on micro timeframes, just like 1 minute. It can be ultra bullish on 1 hour chart, and it can be ultra bullish on 4 hour chart. It can be bearish or neutral on 12-hour chart, but still bullish on monthly or weekly, right? So do not confuse and far-fetch one conclusion from one single time frame to another, because it does not work this way. The markets and trends tend to have the display the fractal nature, right? As the larger trends consist of smaller trends, the smaller trends constitute to larger trends. So all that being said, the fact that Bitcoin is showing a lot of weakness right now, of course, breaking through 37,500 support, is bearish in the short term more often than not, because breaking through the support is bearish itself. It potentially takes you towards the lows of the range, towards the $33,000. And if there is failure, let's say, to close below, it may actually rally it back. But if there is a successful close beneath that level and underneath the support, this can take you in the lower regions, just like I said, 28, 30,000, potentially even lower which is what I would reconsider my of course, which would potentially make a new low and make it a proper bear market, and then make me cash move to realize some long-term profits, right? Probably ahead of cascade of liquidations. But all that being said, you guys, I want to make sure that all the points, all the takeaways, all the notes are going to stay with you. This video is free. It's free to watch. It's free to watch. But I definitely want to also endorse and then give a proper shout out to our sponsors at Prime XBD, because this video is actually sponsored by our Prime XBD, who are our partners. They are an established platform where you can trade crypto, and I can trade crypto, forex, commodities, all from one account. They have very good, cryptocurrency deposits as well, if you will. And well, right now, actually, there's going to be links placed in the description to the video, and you can win up to $7,000 deposit bonus if you actually sign up with the coupon code BirbNest. And all of that you're going to find in the description to this video. And thanks to our sponsors, this video is actually free to watch for everybody. So thanks. And credits go where they are due. And all that being said, finally, just to wrap up the show, the final reminder is, again, lots of uncertainty, lots of dark clouds, recession ahead. You're looking at the worst performing 4-month period in the history of S&P 500. You're looking at very, very big exceptional changes in the markets as the very high inflation hits. You're looking at exceptionally high rate hikes, but still with so far promises from Jay Powell that the Fed is not going to raise it higher per one instance, per one hike. Typically, after some bearish period, which had been maintained over the course of the past months, arguably 6 months, ever since the equities side of the market and cryptos actually peaked in November, eventually the times get better, right? So it's not going to go like this forever. Perception biases, the behavioral finance would say that because of our saliency or representativeness bias, we would think that just because something happened in the past, we would translate it directly in the same way and anticipating the very same results, saying that if the market has been tanking downwards, for the past week or a day or minute, it's going to continue like that forever. But remember, above everything, that I had mentioned, that the past is never a guarantee of a future performance. And what's been dropping, very sharply downwards, can recover at any time because of certain news, and vice versa. The best performing assets, when you refuse to realize the profits because of, for instance, greed or over pessimism, some sort of like complacency, you're likely going to suffer losses eventually because of later on risk aversion, less aversion, and refusal to close the profits. All that, guys, is going to be also hopefully profiting you and benefiting you well throughout your journey. I hope you guys are going to enjoy that as well as free membership for 7 days if you guys want to come and join us in the BirbNest, which is an established platform for traders to discuss the markets exclusively for thousands of people on the platform, one of the largest trading groups, communities of this kind ever since 2017. We've been through the bear markets, we've been through the bull markets, we've been through the sideways, we've been through everything, and we're going to remain with you for as long as you need, guys. Please make sure, if you want to give it a go, for 7 days free to get exceptional trading materials free of any charge while a member. When a member, lots of trading forums, market. Actually, let me show you that. Of course, lots of channels, the trade triggers, ideas for crypto and legacy, the automated signals from Burbicator Pro, which is the trading system that I had displayed and showed to you guys. The webinars, daily webinars, the main discussions going on both for crypto and legacy markets, fundamental analysis, insight, daily webinars, trading tools, trading therapy sessions. Lots of people were really beautifully healed through them. Tons of exclusive resources, my personal trading channel among other traders channels, very, very big amount of useful materials, tutorials, charter requests channel, community charting, market scanners that are going to save you so much time and actually answer filter, do they all the job for you to figure out what is actually exceptionally good to spend time on searching and diving into. If you see, for instance, there is a bullish, huge bull on hourly chart on the ONG, for instance, if you are a short-term trader, you can go ahead and try search for some entries in the setup, but you know that you don't want to stay in that for a weekly time frame, right? So it saves so much time. It works for legacy markets as well, for equities, for indices, for Google. You see for how bearish, ultra bearish, flaming bear on a 4-hour time frame. For Google, for other tech stocks, companies, financials, Amazon, Apple, of course, taking huge hits. Facebook, not needless to say. Equities down globally, and also for Japan. So all of that, guys, is actually going to be accounted and accompanied by premium webinars, by premium video reports, just like this very one from me, by legacy market analysis and reports, reviews exclusively to the members, very beginner pro chats, and so on and so forth. Guys, all that I'm giving you 7 days free. If you want to go and sign up, just put your email on theburbners.com, upper right corner here, sign up free, or anywhere else. Sign up free 7 days. You're going to be charged null, zilch, nothing, literally zero. So all that, guys, to say that I want to welcome all your questions and any points, free of any charge, 7 days out there in the Burb Nest. Come, guys, join it, try your luck, and I see you there around. God bless you all. Bye-bye.